Welcome to the latest episode of Quest for Twice. In this episode, I'm very excited to introduce a new company that I'm investing in. It will become another one of my growth portfolio. The name of the company is called JFrog. It makes software for the software development. Its products support the full DevOps cycle. So we have to talk about the DevOps first. That's shown on the top right. DEV stands for development, and Ops stands for operations. So this DevOps is a continuous process starting from top the left, that's code. Then from there, moving counterclockwise to build, then test, then release, then deploy. Once a software application is deployed, then it goes into operations. So the software will operate and will be monitored with the feedback for plans for updates to the code. Then the full DevOps cycle goes on and on. So the people working in the dev stage are called the development engineers, and the people works in operations are called IT professionals. Now let's look at the chart about the various products JFrog makes. So starts with the VCS, version control software. So that's a source code repository, and JFrog doesn't make that. JFrog starts support to the DevOps after source codes are compiled into binaries. So that's where JFrog Artifactory comes in. It stores and manages packages, including binaries as well as artifacts. And JFrog has a product called X-Ray. It scans and secure packages to find vulnerabilities in those packages to highlight the threats and the vulnerabilities so that they can be fixed to enhance the security of the software applications. Then after software is tested, will be released and distributed to a deployment environment, usually to operation servers or to the edge devices. And JFrog also makes a software called pipelines. It does a continuous integration and deployment automation of the processes from build to test, release, and deploy. These pipelines software will facilitate the entire process. In addition, JFrog makes mission control software to monitor, configure the software applications, as well as analyze intelligence metrics to produce insight to the people monitoring the operations, as well as planning future updates. For JFrog, it's a foundational product. It's Artifactory. So how widely is Artifactory adopted? So as the end of 2020, JFrog has over 6,000 paying customers versus 5,600 at the end of 2019. So 78% of Fortune 100 companies use JFrog products, which is underpinned by the JFrog Artifactory. And 27% of global 2,000 companies use JFrog products. So this chart shows the major customers using JFrog's products, including Google and Microsoft. So those are the who's who in the software development world. And also notable are the banking and the financial services companies, including American Express and Bank of America. The reason I want to mention those is because of the banking companies are very conservative. They would not use something unless it has passed the rigorous standards to ensure the software will perform as expected. So financially, JFrog has been growing its revenue very fast in the last 2 years, with a 44% growth from 2019 to 2020. And it gave a forecast of over $200 million of revenue in 2021. If we look at the quarterly revenue, its quarterly revenue growth has been very steady and also impressively fast. Its gross margin is high at 82%. And that's not surprising given that it's a software company. And its CAGR is about 54% if we consider the 2021 forecasted revenue. So to invest in a growth company, the most important question to answer is, can the faster growth continue? To understand that for JFrog, we need to take a look at the different products offered by JFrog. So, as I mentioned earlier, the foundational product is JFrog Artifactory. And at the level of Pro X, it costs a user $100 per month for each server. Once the user upgrades to the enterprise level, then the cost increases sevenfold to $700 per month per server. And the highest service JFrog provides is the Enterprise Plus. So comparing to Enterprise, it's actually a giant leap in terms of the product offering, although the name is very similar with the Enterprise Plus compared to Enterprise. The reason being that the Enterprise Plus includes JFrog pipelines. So that covers the entire DevOps cycle. So comparing to JFrog Artifactory as well as JFrog X3, the JFrog pipelines covers the entire DevOps versus just managing the packages and the binaries. So although JFrog does not disclose the cost for Enterprise Plus, one would imagine that that'll cost a lot more than the other products. So it's important to look at the JFrog's Enterprise Plus revenue growth. JFrog doesn't provide the absolute revenue contribution from Enterprise Plus. However, it does provide the percentage of revenue coming from Enterprise Plus products. So at the end of latest quarter, that is second quarter of 21, and Enterprise Plus contributed 32% of total revenue, compared to 26% contribution at the end of 2020 and 13% of contribution at 2019. the information tells us that the JFrog Enterprise Plus is being adopted widely in its customers. So in my opinion, there are a number of future growth drivers that will propel JFrog to continue its fast revenue growth. One is secular growth, because more software development is the trend that will continue with the 22 billion total addressable market. So JFrog, with the annual revenue of $200 million, it's a very, very small market share, and that has a lot of space to grow. And also, as I mentioned earlier, its international growth is lagging behind its market penetration in the US. Currently, 27% of Global 2000 are JFrog customers. So there is a lot of room for JFrog to grow there. And also more consumptions of JFrog service per customer. As I mentioned earlier, the Enterprise Plus is contributing more and more to its revenue. So that's an example of more consumption of JFrog service. So currently, JFrog has a 129% of a net dollar retention rate. That means for a customer, if the customer spent $100 last year with JFrog, this year it will spend $129. So that could be driven either by using more JFrog service, like a higher tier service, or it could be because of it's installing JFrog on more servers. And besides, JFrog has been expanding its product offering, for example, security-related products. So all those drivers can drive future growth. Then the question is, will its competitors come in and just squash JFrog? So it's important to understand its moat. So in my opinion, its moat is narrow with the potential to widen. I think there are some switching costs for Artifactory. Once a company is using Artifactory, it'll take efforts and risk of something going wrong if switch all the packages from Artifactory to a competing product. So the switching cost creates some moat for JFrog. More importantly is the moat may widen because if a JFrog pipeline is widely adopted, then it integrates with the full DevOps cycle and becomes much harder for a customer to switch. Actually, according to JFrog, there isn't a comparable product offering by any of its competitors. If a customer switch away from JFrog pipeline, that probably means the customer will have to use 2 or 3 products from 2 or 3 different companies to manage the full DevOps cycle. That's why I think with the adoption of a JFrog pipeline that's offered in the Enterprise Plus, its moat is going to widen. So here is my investment thesis. The JFrog has the potential to dominate the playground it plays in with the go-to product for DevOps, which has a total addressable market of $15 to $20 billion. It currently has a reasonable valuation at 23 times of price to gross profit, with a very fast CAGR. Its current price is about $34 per share. Duration to parity is 8 years. And to understand the concept of a duration to parity, please review my last episode of Quest for Twice. So that provides a downside protection. Another way to look at the valuation is to compare with a different software company that's Intuit, which makes the Quicken and the TurboTax software packages. So Quicken has about 15 times of a price to gross profit ratio. With the fast growth rate by JFrog, it takes about 1 year to reach that level. And Intuit has a much slower growth rate at 17% CAGR. In other words, if the JFrog price stays at $34, it has just takes 1 year for it to reach a fair market price, even if after 1 year its growth rate drops significantly from 47% to 17%, which of course is unlikely to happen. So what are the threats and opportunities to my investment thesis? I think the key is if the Enterprise Plus has a low penetration rate, then the growth rate will decline fast, which will make the JFrog's price appear a lot more expensive. And also, since I don't have expertise in DevOps, I may overestimate the mode of JFrog. Its a competitor, for example, like Microsoft and others, may have products covering some aspects or the full cycle of DevOps, and they may win the competition and put JFrog out of business. Lastly, JFrog has been busy with mergers and acquisitions. The investment return may disappoint and make the investment wasteful. Currently, the return on invested capital before tax is about 9%. Given how small the company is, I consider that as a pretty good ratio, indicating JFrog has been using its capital investment wisely. With all these factors considered, I would say JFrog has a lot of upside with a limited downside. So I'm going to build a position in JFrog and add it to my growth portfolio. Until next time, happy investing.